In this video, we're going to cover the tax formula. So the tax formula is basically, if you look at the Form 1040, which is the U.S. individual income tax return form, there are other variations of this form as well, but the Form 1040 is what's primarily used. It just follows an order, and we're just going to go over that, and it's important to try to understand the order of things in this form rather than memorize. So this is what the form really looks like. You can go online and just Google the form and it will, show up, and you can go to the individual items. But if you were to just look at, the form condensed, this is really what the form could be broken down into. And to summarize, basically, the way the tax formula works is that you first of all take income from all sources. Now, emphasis on all sources. And I'll show you what that means when we say income from all sources. Now, according to Code Section 61, except as otherwise provided in the subtitle, gross income means all income from whatever sources derived, including but not limited to the following items. And it just provides a few items, in that list. So my point here is that we need to look to the code to see which items of income are excluded from income. This is a very small list of items, so it's not, based on a guessing game. It lists specifically which items are to be excluded from income. So if something does not show up on this list, it has to be included in income. Now, as for deductions, it's the opposite. Except as provided in the code, an item cannot be deducted. So we're going to go over, the deductions also later on. But just know that deductions work the opposite way. You cannot deduct anything unless you can find something in the code that says that an item can be deducted. So if you contrast, how the way it works with income versus how it works with deductions, you'll notice that for deductions, nothing is deductible unless it's specifically listed. And for income, everything is includable unless something is specifically excluded. So what this really means is that this method really just maximizes the amount of income that's included in a taxpayer's return and minimizes the amount that they can deduct, which results in maximum tax revenue, which again is the point of taxation, is to collect as much revenue as possible. Now, what this also means is that there are no hidden or secret deductions or exclusions, as you may have heard, tax preparers say, oh, they can get you this deduction, they can get you that deduction. That's not true. It's a matter of fact, and if a taxpayer qualifies for a certain deduction, it will be provided, by any other tax preparer. They, have no monopoly on any deductions that others cannot get as well. So now let's go back to the tax formula. So first of all, we start with income from all sources, as I mentioned, and then we'll look at the exclusions from income that are provided in the tax code, and then we come to gross income. Now this is really where the 1040 starts, and we're going to look at them side by side. After the gross income, you take out deductions for adjusted gross income, also called AGI. Now this is very important to make a distinction for deductions for AGI and deductions from AGI. So these deductions right here are deductions from, and these are deductions for, and I'll explain why. Also called above the line deductions and under the line deductions. So this is the line, and deductions for AGI are called above the line deductions, and deductions from AGI are called below the line deductions. The reason this is important is because deductions for AGI you will always get unless they're phased out, which don't worry about that right now. So the $5,500 here is guaranteed to the taxpayer. However, the deductions from, it depends, because you take the greater of either the standard deduction or the itemized deductions. We're going to cover what each one of those are, but just know for now that deductions from AGI depend on whichever is greater, either the standard deduction or the itemized deduction. So in this case, taxpayer had $5,000 of itemized deductions, but they will kind of lose this because the standard deduction is greater and it makes more sense for them to take the standard deduction. We're going to cover that again in detail later on. Then you take, after you do the deductions for AGI and deductions from AGI, you take the personal and dependency exemptions, which is $4,000 for the year 2015. This is per person. Then we come to the taxable income, and then based on the taxable income, there's a total tax that's calculated. Basically, you take the taxable income times the tax rate. Software does this. There's also a way to do this manually, which is how I did it. Then you take the credits. Again, we're going to cover each one of these items individually and in greater detail, but for now, just to get a broad idea. Credits could be something like the earned income credit, or credits would just be payments you've already made, payments that are deducted from your W-2, payments that you make as you go through the year. So you compare the tax that's owed with the amount that was paid during the year, and you come up with either a tax liability or a refund that's due to the taxpayer. In this case, in this example, a taxpayer actually owes $1,993.75. Now let's look at the 1040 to kind of contrast the two, well, compare the two, and see the link between the two. So the first thing you will notice is, which I mentioned, is that the tax formula, again, starts at income from all sources. However, on the 1040, you don't see this $10,000 exclusion because things that are excluded don't even show up on the 1040. They do not show up here. So line 7 to line 21 is really gross income, and that's basically all the income items that were included. So you have, wages and salaries, alimony, business income. Just to give you an example, when you take all of these items, so let's say this person only had a job and they got $90,000 from their W-2. The total combined amount is $90,000. So this is their gross income. This right here is this. Next thing is the deductions for AGI, and these are all the deductions for AGI that are allowed by Congress. In our example, the individual had an IRA deduction of $5,500. So if you take the $90,000 and you subtract the $5,500, you get to the adjusted gross income, the AGI, which is $84,500. This adjusted gross income is this. It just carries forward to the next page. So now these again are above the line deductions, so deductions for AGI, and then we're going to look at this line right here, which is deductions from AGI, or below the line deductions. So you can think of the line as just where the page separates as well. Now again, this is either the standard deduction or itemized deduction. If you look here, it says itemized deductions from Schedule A. So there's a separate schedule where you calculate all your itemized deductions, or your standard deduction. You can choose the lower amount if you want. You can choose the $5,000 instead of $63,000, but no one does that because that will get you a lesser, you'll be paying more in taxes, so you always go with the higher amount. So in this case, we chose the $6,300, and then it just says to subtract the AGI and the deductions from, which is the standard deduction, to come to $78,200. And then if you just follow it down the line, the exemptions, which is the personal exemption, is $4,000. Again, it says, don't worry about this, but it says multiply $3,950 by the number on line 60. So this number changes. The exemption amount last year was $3,950. This year is $4,000. Next year will be maybe $4,050. So don't worry about that. And then you get to the taxable income of $74,200, which is what we got here as well. And then you just calculate the tax based on a sheet, but TaxWise calculates that for you, or any other tax software. And it's coming down, we compare that to the different credits that the taxpayer may be eligible for, or the payments that they've made. In this case, we just came up with a number that they paid $12,350, and then you compare that to the end amount, which is either the amount that you owe here or amount that you overpaid, which would be a refund here. But in this case, since they owe, which this is the amount, $1,993.75. So this basically is the tax formula. Again, just very important to understand the flow of it and understand the distinction between the deductions for and deductions from, which is also known as above the line deductions or below the line deductions, and see how the things fall through. Eventually, we're going to work through these different things. We're going to cover, exemptions, and then find out how you can get more exemptions instead of the 4,000. How could they have gotten more than 4? And then we're going to figure out when the standard deduction applies instead of the itemized, or when the itemized would apply rather than the standard. We're going to cover the different deductions that this taxpayer could have gotten, and the different income items. So each one of these line items itself expands greatly, as you can just see in the tax formula. Even though it's one line here, the total, but there's different items within this, and then each item has multiple schedules. So the tax formula itself is simple. However, there's a lot of nuances and then a lot that goes into it. We're going to keep it basic for now for our purposes and leave it at this. So just again, go over the tax formula, this right here, and take a look at the 1040 and try to see if it makes sense.